I just sat down with Ed Slott, a CPA and nationally recognized IRA distribution expert, professional speaker, TV personality, best-selling author. Wall Street Journal even named him as the best source for IRA advice. And I really wanted to get his insight around what the future is going to look like with taxes, his thoughts on life insurance, which he's a big fan of.
The income tax exemption for life insurance is the single biggest benefit in the tax code and not used nearly enough.
And just what you should be looking at as you're entering retirement, or if you're an advisor that's helping people with retirement, what are the things to look at?
The Secure Act a few years ago changed everything. You could stretch the IRA for the beneficiaries and get that long tax deferral of 20, 30, 50, even 70 years. That's gone. All that money you saved, most of that will be lost to taxes. And that's even if it was at today's rates. We don't know what future rates are. I look at our debt levels as a deferred tax on all of us. I mean, where's the money going to come from? They spend more than they bring in, and they bring in plenty. They know we made that deal with the devil years ago. We got a tax deduction up front. We said, all right, we'll pay later. Well, later is coming.
I'm telling you, get your notepad out because he dropped bombs in this episode. Let's dive in. Ed Slott, welcome to the BetterWealth Show.
Well, it's great to be here with you, Caleb. Finally.
Finally, man. It's an honor to have you on the show. We are having our 5th annual Life Insurance Summit in Franklin, Tennessee. It's June 15th through the 17th. You're going to be our keynote speaker on the 16th. And I've been wanting to get you on the show and at this event for a while. It finally happened. And I would love for you to just give a little bit of insight. You're the IRA guy. You're the tax guy. You're very much known. I mean, you've done so many things. You're very much known as one of the go-to experts when it comes to retirement planning, and you're not in the insurance space at all, and yet you're a big fan of it. And that's why I'm excited to bring you on, because you don't sell it, but you endorse it in some way. And so why don't you just give a little bit of insight of like what's going on in the politics world, what's going on in the IRA space, what's going on in the retirement space, and how that might make or break the life insurance, it just as it relates to what we do.
Well, you're right about the life insurance. So for those who don't know me, I'm a CPA, a tax advisor. I had a tax practice for over 40 years. I've pretty much seen it all in the tax world. So that's who I am, a CPA tax advisor. I never sold any kind of financial products. I don't sell stocks, bonds, funds, insurance, annuities, none of that. But I always tell people when it comes to life insurance, the income tax exemption for life insurance is the single biggest benefit in the tax code and not used nearly enough, even by financial professionals who sell the product, because many times they don't really give all the benefits. So not only am I a believer in it, because I love anything, and that's how I spent my whole career, that reduces taxes for people. And life insurance is one of those unique vehicles that can not only reduce taxes, but leverage taxable money into tax-free money, where you actually end up with more money and more of it tax-free, not to mention that returns are guaranteed in most aspects of that. So that's why I love it for planning, even though I don't sell it, but I have it myself. And I'll be talking about these things at the program we're going to be doing, getting more into it. But I will start with the big problem right now is that, well, some people call it a problem. Some people think it's great that the market is way high. People love to see their IRA balances jumping up and up. What they don't realize, I don't think most people, is that IRA, it may not all be yours. It's definitely not all yours, because at some point it's going to be taxed. And we don't know what those rates will be in the future. We know what rates they are now. So most people, I believe, are overweighted. They have too much money in IRAs. They have no tax risk diversification. So that's what I'll be talking about, because now, thanks to the recent new tax deductions and features of the ABBA law, the One Big Beautiful Bill Act, this is the right time to start reducing these balances using tax strategies like Roth IRAs, even charitable planning, but also life insurance planning. In other words, what I'm saying, now is the time to, as far as IRAs go, to use them, leverage them, or lose them to possibly larger, higher future taxes. That's what I worry about. I look at our debt levels. I mean, I don't even know what it is, 37, 38, 39 trillion. All I know is if they have to round up to the nearest trillion, that's a problem.
That's like, well, that,
and
that
I
could
look
be
at the U.S. debt as a deferred tax on all of us. I mean, where is the money going to come from? They spend more than they bring in, and they bring in plenty. Believe me, they bring in plenty. They, the government, they bring in plenty of money, but they spend more, and they owe more. So really, the only thing they can do, if they ever are serious about addressing the debt and deficit levels, is at some point to raise taxes. So here's why I worry about these large IRAs. That's the low-hanging fruit for Congress. Remember, this money has not yet been taxed. It's the low-hanging fruit. It's easy pickings because they know we made that deal with the devil years ago. We got a tax deduction up front. We said, all right, we'll pay later. Well, later is coming. But right now we have this little area, thanks to the extension of the low tax rates that was in that One Big Beautiful Bill Act. It was a permanent extension of the low rates. But let me stop there. The word permanent in the dictionary has a way different meaning than the word permanent in the tax code. In the dictionary, it means what we all think it means: etched in stone, unchangeable, irrevocable, permanent. In the tax code, it only means till a future Congress changes the rules. So we may only have a few more years of these unbelievably low rates. So now is the time to strike. We have rates that are unheard of. 12%, 22, 24% rates. This is the time to bring these IRA balances down and leverage them to tax-free vehicles. I call things like Roth IRAs and life insurance tax insurance because you can lock in today's rates. The money's going to come from the IRAs. Remember, doing nothing is not an option. That's going to be one of the big messages. Doing nothing, just sitting there watching your IRA grow, it's like watching a joint account with Uncle Sam grow, because that's essentially what it is. Uncle Sam is a partner on your retirement savings. And if you don't do something now, you get what I'm going to call, I always call, the government plan. You either want your plan or the government plan. I say that in every seminar, and I'll elaborate when we get there. But sometimes people ask me, Ed, you keep saying you want your plan, not the government plan. What is the government plan? Maybe I'm interested. No, I'll tell you this right now without even coming to the pro. You're not interested in that plan. But if you must know what it is, it's the world's easiest plan. Sit there and do nothing.
Yeah. It's the
default
default
plan. Let the government just tell you how much to pay and when to pay it, and you write the checks. It doesn't have to be that way. You can actually end up with more than you have, and that's the big difference that I like with life insurance. It's the only one that's really leverageable of the alternatives, like Roth IRAs. Well, charitable planning is a different area because you do that because you have charitable intent. But the leverage of a taxable account into tax-free is how some people end up, and I've done this with clients over the years. In fact, I've had beneficiaries call me after we did this planning with the life insurance. Again, I don't do that. I would send them back to their insurance person, and some people listened to me, some people didn't. But I've had beneficiaries over the years questioning after their parents died. They said, I remember one beneficiary in particular, he got this big insurance check, and he called me up in this like whisper voice, Ed, I got this $5 million check. Is this legal? I said, yes, you were in the meeting with me and your parents. He said, don't talk so loud, they'll know. I said, who'll know? He said, the IRS. I said, they don't care. I told you at the meeting. I told you 100 times. It's absolutely tax-free. And then he would say, not he would, he did, but some others would say, but how is it possible? How is it that I can inherit more than my parents ever had? And it's all tax-free? Is this legal? What do I do with the money? That's just what this guy said. What do I do with the money? I said, I don't know, invest it, put it in the bank, get more insurance yourself and leverage that. Yeah. So it's such an unbelievable it's the best tax plan I can think of. May not be for everybody, but if you are coming to this program and you're worried about, if you're a financial advisor, you should be worried about your clients building up too much in IRAs, especially with the growth in the market. I'll bet every financial advisor has lots of clients with $1 million or more in IRAs. So you might want to know, why do I say it's a lousy asset? Because the Secure Act a few years ago changed everything. It used to be we did the planning with the IRAs because you could do something called stretch. Do you remember that? You could stretch the IRA for the beneficiaries and get that long tax deferral of 20, 30, 50, even 70 years if you had a 10-year-old beneficiary. That's gone. Now, all of those funds, all of this buildup I'm talking about in the IRA will have to come out. It has a closer end date, a shorter window when all this tax has to be paid. And that's 10 years after death. So in year 10, when your non-spouse beneficiary, like your children or grandchildren, inherit, at the end of year 10, they will have the government plan. They will have a 100% RMD, required minimum distribution. All that money you saved, most of that will be lost to taxes. And that's even if it was at today's rates. We don't know what future rates are, but we can lock in today's rates. And that's where I said insurance, life insurance, and I'm talking about permanent, not term insurance, cash value life insurance like I have for myself, is the way to leverage, turn bad assets, IRAs, into good assets. And that's really what I'll be talking about, exchanging bad assets for good assets.
I would say I have a comment and then a question. So no one goes to the DMV and says, you know what, I want these people running my retirement plan. So I think most people would agree with you that they should take control and want control.
Right.
An observation I have is it seems like in the retirement space, there's investment people that hate insurance, and then a lot of insurance people that default. It's almost like they're like beat down and they're like, hey, insurance is better than investing. And I look at it as an integration, and it's a and is better than or. Why do you think life insurance is so misunderstood?
I don't understand that. If you're a good financial advisor, you always do what's best for your client. Of course you want to invest money, but life insurance, I think, for those, not for everybody, but for those people that are building up those large IRAs, $1 million plus, it's too much. It's too much in taxable territory. You have all your eggs in one big taxable basket. As I said, you have no tax risk diversification. The life insurance gives you that piece. And I have both. Anybody should have both. I have the life insurance, but I also have money invested as well. They're not mutually exclusive. Like you said, they should be integrated in a plan that works best for your client, or if you're a consumer, that works best for you. You should have some balance. But the insurance gives you some security. And I think what most people don't realize is that the insurance can be tapped into during your lifetime. That's the single biggest benefit I see. Lifetime benefits, the ability to take, I'm oversimplifying it, but take advances on your life insurance, take distributions out of it, take withdrawals from the cash value if you need it. Most people, it turns out, don't need it. But I think that's why the average consumer may shy away from life insurance, because they think it's not their money. It is their money. It will be somebody else's money when they die, but it is available to them in a well-structured policy now. Yeah. And it's available tax-free.
Yeah, one thing that doesn't get talked about nearly as much as it should is the chronic and critical illness riders that a lot of these permanent policies have. The ability to tap into the death benefit prematurely if certain things trigger, activities of daily living and all. And because most people do not have long-term care, people should, most people don't. And so it's another benefit. It's like, how do you measure that? Those kind of things don't necessarily exist in other assets. Real quick, before Ed answers this next question, one of my favorite quotes that he has on life insurance is the single biggest benefit to the federal tax code is the income tax exemption for life insurance. If you want to understand better how life insurance can integrate with your retirement plan, we have a link down below for you to talk to someone on our team. Let's get back to the episode.
I think that's the single biggest benefit with the long-term care riders. I only learned about this 11 years ago. I know it was 11 years ago because when I learned about it, and it wasn't available in all states. I don't know if it's still, it's more widely available now, but at the time it wasn't. It was kind of new. And somebody explained it to me, somebody like you who was into the insurance. I said, what? This is way better than a long-term care policy. You get the best of both worlds. You have the death benefit. You can access the cash value for long-term care or other reasons, depending on the policy. So I upgraded my policy, and I know it was 11 years ago because I took a 10-pay policy payment premium schedule on it. And this is the first year I didn't pay. I finished my 10 years. This is the 11th year, so I know it. And I have to tell you, now, I don't know if what I'm saying is true for everyone, but you have to see it and work through the plan. That's something I'm going to talk about. In my own case, now it's in the 11th year. The premiums pay themselves now, or however that works. You probably know better than me. But the cash value, and this is what I can't get over. This is why I'm so passionate talking about it, because I have it for myself. The cash value is more than I paid in premiums over the 10 years. And I had the death benefit if I needed it, and the access to the money if I needed it. Luckily, I didn't need it. And all of that gain is income tax free. And that's what I call highly leveraged money. So wouldn't that be a great use of somebody who has too much in taxable IRAs to start bringing that balance down while rates are low? That's why I say all these factors are great things. This is a great time for you to be having this meeting because we have the lowest rates in history. We have great tax benefits now, maybe even for a few more years. So now is the time to strike, to turn bad assets into better assets. So I have that myself. That's why I can speak about it so passionately, because I see the numbers.
When a lot of people, what they'll say is insurance is a terrible investment, and insurance is not even an investment. That's where they get themselves wrong, but they compare it to the growth rate. And what I hear you saying a lot is you're just looking at, yes, diversification is a real thing, but very few people are talking about tax diversification. And your whole deal is, and your latest book is The Retirement Savings Time Bomb Ticks Louder. And I have your other book over here, which you seem to have a common theme, and your whole deal is...
Well, if you notice, in my book on page 275 is the title of my life insurance. And this is from a non-life insurance person. You see the title of that chapter, The Power of Life Insurance. And the subtitle is Larger Inheritances, More Control, and Less Tax. The reason I put that subtitle on it is because after many, many decades, like I said, of doing estate planning and tax planning for clients, when I would sit down with clients, first thing, like any advisor would do, why are you here? What do you want to accomplish? What are your objectives? And over the years, they didn't say it exactly, but everything they wanted came down to one of those three things, or all of them. They wanted larger inheritances for their beneficiaries, more control because they didn't trust their beneficiaries with all the money, and less tax. So that's why I subtitled Larger Inheritances, More Control, Less Tax. Life insurance checks all the boxes. Now, you might say, well, how do you get more control with life insurance? Yeah. Well, you can leave the life insurance to a trust that accomplishes two things, protection and control, and it can even reduce estate taxes, unlike a Roth IRA. A Roth IRA, believe me, everybody knows I'm a huge Roth fan because I love anything that generates tax-free money. I love tax-free. You always keep more of your money. One of my lines in every seminar, I'll probably say it 10 times in your program, tax-free is always better. You cannot beat. It's the most tax-efficient account, like a Roth IRA. But Roth IRAs are included in your estate. Life insurance has leverage growth, income tax-free, but it also can be set up to be outside of your estate. So you could leave life insurance to a trust. And in the trust, you can customize your own provisions, evasion provisions. You're worried about beneficiaries. And every one of my clients, was always worried about the beneficiaries. They wanted control. They were worried about them getting too much money. They're worried about divorce and bankruptcy and them getting taken advantage of, being preyed on. They're being vulnerable to predators, getting in trouble with money, can't manage money. The number one thing clients used to tell me when they came to their kids and the money that they'll get, they'd say, it's not my kids I worry about. It's the ones they marry. They would always say that because they say, why would I leave all this money to, and it could end up with somebody that I don't even know. Yeah. So the trust really worked. And we used to leave IRAs to a trust, but that doesn't work anymore after the Secure Act for a whole bunch of reasons, mainly the loss of the stretch IRA and the 10-year rule. But the life insurance is probably the best. It is, not probably, is the most flexible asset to leave to a trust, because now when the life insurance goes into the trust, it's not messed up with RMDs and saddled with all these IRA and tax rules. You can customize your plan. I did that years ago in my own plan when my kids were much younger. I always had life insurance, but I had it set up in a trust in case I died while they were still young. And I made my own provisions. And you can do the same thing. In fact, what I did is I said, if I died before they turned 25, they get half at 25 and the rest at 30. In my mind, I gave them 2 chances to blow it, and then I'm out. Now you're on your own. But the point is, you can get your own plan, whatever's important to you. And you can do that with life insurance is the only asset you can really do that with and get the leverage and the tax-free benefit. And if you set it up outside the estate, that may not be for everybody, but if you have a large estate, you're worried about an estate tax, life insurance can be set up to be estate tax-free and income tax-free. Or you could just own it in your own name and leave it to a trust. That's fine too. And you can dictate the provisions when people get the money, and you can have post-death control and protection. So life insurance is a very flexible vehicle for wealth planning to the next generation.
And we're coming up on time, so I got 2 more quick questions.
Well, you can see how I can talk for a long time on this, and you're going to get plenty more. What you're going to learn.
And I want you all to know this. At my event, majority of the speakers speak for 20 minutes. It's like a TED Talk style deal. You're going to do a whole 90-minute session, and it's going to be incredible. And it'll
go in 5 minutes. Look at us going now. Well, yes. We're just talking.
Just like this podcast is gone.
I would say bring a lot of paper, or because you're going to get carpal tunnel writing notes, because I talk fast, as you see.
Yes,
most people say listening to me is like drinking from a fire hose. So get ready for that. But it's going to be, all the hits will be coming, and it will change the way you look at your retirement savings and how to plan it out. And the bottom line is to have more, keep more, and make it last, to have more money and more of it tax-free, and reduce future tax risk uncertainty.
So I love everything that you just said. So I'm a big fan of Ross as well. How do you decide what to do first when it comes to when you have an IRA balance? And I'm sure you're going to break down that more in detail.
Yeah, I will talk about that because I have both myself. I believe in both of them. And there's reasons for both of them. And there's plus and minuses. They're both great, but they have subtle differences. I'll go through that at the program. Again, nothing is mutually exclusive. Just like you said, the investments, the Roth, the life insurance, but the plan should be to keep more of your money, to pay the least tax possible, not today, but over a lifetime, and multi-generational to beneficiaries as well.
Ed, last question. What's your thoughts on brokerage accounts? And there can be a lot of tax benefits, especially, if you're not taking out massive amounts of money each year from just regular brokerage accounts.
Brokerage accounts are great to be in the mix too. Look, the advantages they have are several: long-term capital gain rates, and if you hold it to death, there's the step up in basis. So there's a play for that too. It's not, everything is together, and that's what you have to learn as an investor and as an advisor, to make sure you have your clients covered in all areas. I have that as well. I have a brokerage account, I have Roth, everything we talked about. I have the life insurance. You really have to diversify in every area, and everyone has benefits, and the brokerage account has those 2 big big benefits. If you do sell, you get the long-term capital gain rates if you hold it more than a year. And if you hold highly appreciated assets, it's a free ride for the beneficiaries with the step up in basis.
And putting life insurance aside, just looking at where we are, we're recording this in 2026. Obviously, our event's happening in June. There's a lot going on. You've mentioned the Tax and Jobs Act deal. President Trump's got 900 plus days in office. What are you looking at right now, just in politics, where we're at? Is it all the tax time? Like, is your book kind of summarize where your head's at, or is there other things that you're open to? Are you a bullish on Bitcoin? Like, is there any other things that you're looking at?
I'm not an expert on any of that. I stay in my lane. Let the Bitcoin dudes do what they do. I have to be with things that I understand, and maybe that boat is past. It's for younger people. But I will say I've come across a lot of younger people who made a fortune in Bitcoin, but I had many who also lost a lot of that money. And younger people have an advantage. They have many more years to kind of learn their lesson and recover from it. And they also have parents that can bail them out. If you're older, you may not have that advantage.
Yeah, I love it. Well, Ed, we're very excited to be with you in person here in June. And I'll just say, if you're watching this and you're a fan of the show, be in person with us. We'll have more details on the event below. But I would just say, just from what we're going to get from your session is going to be incredible. I've been trying to get you on the show for a while now. And so thank you for being here. Thank you for coming on. And I very much look forward to shaking your hand and thanking you for all the stuff that you do for the space, not just the life insurance side. Like, you train so many financial professionals.
It's not that I'm on the life insurance. I'm on the good planning side, lowering a lifetime of taxes, keeping more of your hard-earned money. That's what I'm about, and using the tax code to do it. And life insurance happens to be the single biggest benefit in the tax code.
Yeah. And I'm with you. What I'm trying to do is change the stigma, because there are people in the life insurance space that make the stigma real. Like, they push it at all costs. But from an integration standpoint, I'm hoping that we can make this message less controversial, and have
it shouldn't be controversial. Everybody, you talk about politics. One thing I love about my programs, there's no politics, because everybody likes what I talk about. Everybody wants to pay less in taxes. They're all with me. Believe me, it doesn't matter what side of the aisle on. Everybody wants to keep more of their money, and I'm going to show them how, and you will too.
Amazing. Ed, thank you so much.
All right, I'll see you there.
Ed Slott. He is America's IRA expert. He's America's leading CPA. He's the gentleman who's essentially the advisor to the financial advisors, or to the certified financial planners.
My name is Tom Wall. I have spent 22 years in the life insurance business, positioning whole life insurance and competing against its alternatives.
If anyone out there thinks they have a money problem, it's not actually a money problem. It's a mental capital issue. The Rockefellers were really big on this. They made sure to have trusts and insurance on every single heir.
Every plan should include some form of life insurance. And if you have a family, you owe it to your family to have it.
The other thing that I love about cash value life insurance is that with many of these policies, you can receive your death benefit in advance of your death for the purpose of paying for long-term care.
Instead of borrowing money from the bank to buy a house, a car, a home remodel, or debt consolidation, you become the bank.
When the money goes in, it accumulates without current taxation. When you take it out as a retirement benefit, it is paid out tax-free. And when you die, the death benefit is paid tax-free. Let me ask you something. Don't you think you ought to get out there and tell America this right now?
How do we become the person who's solving complex financial problems? People don't care about life insurance. They care about solving problems.
The life and annuity insurance industry has radically changed over the last couple of decades. The regulators have to apply fairly strict scrutiny on these companies, but over the last several decades, that has eroded significantly.
I think you represent intrinsic value, and intrinsic value is not measured by how much money you make, but by the size of the problem that you can solve.
Hello, I'm NAFA CEO Kevin May.
Barry James Dyke is not your typical guest. He's a researcher, an author, and frankly, one of the only people I know who's willing to take shots at powerful institutions and back it up with actual receipts.
live by the rate of return, die by the rate of return. If we're buying investments because they just have a return that we heard about, and it's outside of our investor DNA, then most likely that is going to fail.
Whole life is genuinely a win-win situation. IUL is still a zero-sum game.
You are financing everything in your life. Even when you pay cash, you're still working with borrowed money.
College funding is the number one financial fear of most American families. Number one financial fear. Yet less than 3% of advisors truly focus on college funding.
I got so guilty that this was so good. 6% of that 4.059 number is $205,000, just $43,000 more than the 4%.
Celeste Moya is a partner at Robin Glenn, known for delivering strategic insight and helping clients protect, grow, and sustain wealth across generations.
We're one of the top 10 mortgage companies in the nation. We do about $20 billion in originations per year.
Every person in this room, whether you believe it or not, is starving for validation. We all have to self-actualize. We have to have meaning and purpose. Nothing wrong with it.
Premium financing, at the end of the day, is borrowing money from a bank, using that money to pay premiums on a life insurance policy.
We need a voice in Washington, because typically in Washington, if you don't have a seat at the table, you're on the menu.